Hey everybody, this is Paul doing a quick little dividend video here. So I'm gonna try and give you a general idea of what's going on in the market because it's definitely interesting to explain what's going on here. So basically, going into November 1st, there was no reason to believe that the Treasury was going to do anything different than what they were doing. Well, as I've said in previous videos, the bond market is telling the stock market what to do, and it's going to stay that way because we are issuing a lot of debt and it's got to get issued somewhere on that curve, somewhere here, somewhere right here. Twos, fives, 30s, tens, up in there, sevens. So, you know, previously in the last quarter, the last 3 months, they were issuing all that debt in this long area right here. Well, the problem is this is where people take out their mortgages at, and this is also where companies take out their debt at, in the 10 and the 30. So, you had a big competitor driving up yields. And as you can see, as yields on the 10-year went up, the market went straight down. And what happened is on November 1st, somebody you should be following on Twitter, Andy Constant, he put out a tweet as soon as the Treasury said where they were going to issue their debt at. He said, buy all assets, pile in. And he was correct because he understands, and a few other veterans of the market understand, is that the this was going to rally because people were going to price in peak yields, as they like to call it. And peak yield is when you're able to get that best rate for 10 years, 5% or something like that. You know, just barely hit that 5%. Whoever got in there, ended up with, 10%. And then it just dropped off and then dropped off and then dropped off. And then people start to price in the drop and then it drops even further. That's kind of how this ends. But I don't think we're there yet. I don't think the bond market thinks we're there yet. We're only talking about a 3 month period here. So basically, the Treasury said they were going to issue a majority of the debt on the short end. So what that means is the 2 year is going to stay right where it's at, and the 5 year is going to stay right where it's at, that kind of thing. But the 10 year dropped like a rock. And then also, what happens is when you add in a CPI report that finally starts to reflect reality of a slowing economy and slowing shelter cost, which has taken forever, um, you basically just get a core CPI, which is excluding food and energy, but this core right here. So you get a core report of 3.2% and you get a headline report of 4%. Well, the Fed funds rate is 520 or 550 right now or something like that, or 525 to 550. So, you know, that's what you get. So the market just basically goes up in a straight line. That's kind of how this works. As people start to price out rate hikes, and this bond market moved by a huge percent yesterday. It moved by a very large amount of money. Um, I think the 1 day is just it looks ridiculous, or maybe the 5 day. But you can see it was like as soon as that report came out yesterday. Look at this. Like that's what it looks like on a chart, on a 5 day chart. Like you can just see it just drop like a rock, and the market literally it's an inverse correlation now. So the market almost went up in a straight line that looked just like that, just a ridiculous amount. So it's kind of pricing in. The market's kind of right now. The market's it's ignoring what's going on down here because Target came out with like the retail earnings came out or retail sales report came out pretty good, which means the consumer's still strong. But I mean, at the market's going to start to notice this right here. Probably tomorrow. It should sell off tomorrow, I would think. Um, Plus, you have so many Fed members that are trying to just talk the market down. Um, they won't ignore this for much longer. I'll be surprised if we end positive today. I'll be kind of surprised. Um, so as a dividend investor, what am I looking at? Obviously, um, I'm trying to buy as low as possible so I can get the highest dividend yield. Um, you can kind of see, so my municipals are reacting to the bond market today. Um, so that's where I've been adding into municipals a lot. That's where I've been putting a lot of my money, just for the tax-free benefit of it. But for the month, here's where we're at currently. So started the month at 60,000, now it's 65, and I've only added $190 from my DoorDash money because I've literally only been using the DoorDash money. I've been saving up the DoorDash money because I have property taxes. So I've only added $190 to the market myself. So, majority of everything that you see here is just market gains. 9% gain in a month. And you can see the dividend's barely going up, you know, because that's just, dividend reinvestment and whatever. But, you know, that's all market returns. So that's why you got to stay in when the market's just tanking like that and it doesn't make any sense. Now, if we had a job report that was coming out saying like millions of jobs lost or like, people were cutting jobs, that would justify the market going down. But the Bears did that thing that they did in October of 2022 or 2022 where they were pricing in something that just doesn't make any sense. And this time they were only able to get the market down to about, I think, 4,200 at the low or something like that. Yeah, they were only able to get the market down to 4,100 this time around. That's the best they could do in October with all the pessimism. I mean, last October they were able to get it down to 3,600 or something like that, but they couldn't even get it down close to what they had gotten it to before. So I think bears just need to accept reality that if we are going into a recession, it's not happening right now. I mean, because this chart just screams soft landing, and the chart just screams soft landing. And the reason it does is because if you go right here, like this is a thing that everybody forgets about. The Federal Reserve, the Treasury, and the FDIC rescued the regional bank system of the United States. They intervened. We should have had a recession right here. Big time recession. Most of the regional banks that are around you right now would probably be closed. It was contagion. They were being forced to mark down every asset on their book because the bonds that they bought and house loans that they have and all that stuff and all these buildings that they own are worth nothing. They can't get rid of them. If you have a 2% mortgage on your books and people are paying 8% mortgages now, who's going to buy the 2% mortgage off your books if you have to sell it? It's worthless. So I think a lot of people forget that BTFP program that nobody talks about anymore, which gave people loans or gave banks loans on their assets at par as if they were worth the full amount, rescued the regional bank system in the United States. That was your credit event. That's your credit event that would have killed consumer credit. Employers would have been immediately forced to lay off millions of people very, very quickly because they would have lost all access to credit. Like their only access to credit would have been the big 11 banks. It would have killed the entire regional bank system in the United States. This was your recession right here. And as soon as they did that, you can see what the market did. So I think bears need to accept that was your credit event you were looking for. Now, is there another one further over here? Possibly. I mean, if they keep rates this high while inflation keeps going low, you're going to have another credit event. Or you're going to have them come in and come up with another program. Because you can't just shut down the housing market for years on at a time. It just doesn't work that way. So, where are we at right now? Inflation's going in the correct direction. The market, I believe, have sniffed out peak rates, at least in the 10-year. I believe the market has sniffed out peak rates, and it looks like they've sniffed out peak rates at a rate around 5% on the 10-year. So right about there. So I think any time that the 10-year starts to go up at all, it's going to get bought immediately. So that's what that means. The bond guys might try to push it, but I just don't see the Treasury issuing a bunch of debt on the long end again after what just happened, especially going into an election year. They're going to issue all that debt on the short end. They're going to issue as much of that debt on the short end as they can. So 7, 5, 2s, 1s, that type of thing. And then it helps that, oil is just tanking because the economy is slowing. There is a slowdown out there. I can tell you that right now. But and our production is just through the roof. So I think it's kind of looking good that maybe the market bottom was definitely in October. So this was definitely looking like the market bottom right here. Um, this is your first. This was the retest, and then we broke out of it, and we've been in an uptrend since. So, and then you got the regional bank rescue right here that nobody talks about, but I think that kind of really changed the market. So what am I doing right now? Mostly just adding to my same positions I've been adding to. Just probably still going to add into BBN, like I said. Um, just keep doing that. And as it stands right now, the plan's working. And then the market is pricing in cuts starting in May. 50% chance of a cut right there. So as you can see the implied rate, as they say right here. So right around May is when they say that the market is starting to price in cuts, and then it gets much higher. So the market is expecting inflation, as they say, to be defeated around May, around that May meeting. So 5 months of higher rates. We'll see if the economy holds out without too many job losses. Um, it's debatable. Let's put it like that. Maybe tax returns might bail out some corporations. I don't know. As we get closer to that amount, um, or as we get closer to May, if they're still talking about tighter rates, it might get nasty in the market. Um, but inflation needs to keep coming down, which I think it will. Just for the simple fact is that there's just too much backdated data that shows that it should be coming down much faster than it is. And you can kind of see, as I showed on that inflation chart, you can see how much shelter just makes up. Prior to the great inflation, look how much shelter made up. Barely any increases in reality. Most people live. They can tell you that rent always went up, but you know, this isn't happening right now. This just simply isn't happening. Like you can just look and see discounts. Anybody who tries to raise rents right now immediately is dealing with having to evict tenants. They don't want to do that because that means empty apartments. Um, it's just not happening. It's just not reality. So we're still waiting for the data to come in, but this little pink or this purple part should start to get much smaller very quickly, hopefully very soon. And then that's going to take out the inflation. And then it's going to keep coming down, which is going to be hilarious. So we'll have to see how that goes. But I think the market could, and this is a big time could, break to higher highs. So the previous high was right up here, and we're maybe 10% from that. So we could break this. So that's the number you're looking for right there. 4,800, 4,808 was the old high before we went into this bear market here. But we could break that, I think, maybe around March. I think tax returns will drive us higher to new highs by March. I'll make that prediction. I feel safe doing that one. Um, we just have to see how debt issuance goes. Obviously, we know for the fourth quarter, it's like looks pretty good. Even though Andy did post on Twitter that now he's saying sell all assets, but he tries to time the market. He thinks we ran 10%, and that's enough that we're probably going to have a pullback, which I agree with. I could easily see that. Is it some major pullback? No. Do we pull back to maybe 4,400? Yeah. So, so that's where I'm at right now. You know, Let me know what you think in the comments. Like I said, right now, as a dividend investor, you're just investing on the way, and you can kind of see the results. This is what happens. You just keep investing, 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 and you know, down 4,000 in 2 months, but then all of a sudden you're up 5,500. That's just how it works as a dividend investor. It's just what happens. You can't control it. It's just what happens. So, you mostly focus on the dividend number coming in every month, but you do look at the headline number, obviously. But, that's just how it works. You just keep buying the dip. And right now, I think we're just in a generational buying opportunity because once it breaks new highs, I don't think it's breaking lower anytime soon. Um, your best time to buy was when everybody was telling you to sell. October of 2022, all the way up until now. Um, so that tells you how more wrong those guys were. So that's where I think we're at right now. So, let me know what you think in the comments. Y'all have a nice day. Thank you.